All right, welcome back, everybody, to episode 8 of the Finance Operators Podcast. We've got a pretty full docket here. We're going to run into a couple good things. So, Mehtab, give us the quick agenda.
First of all, we're gonna marvel at my T-shirt, my Carta-Cola T-shirt. Wow, very cool shirt, very funny.
For those of you watching on YouTube,
10 out of 10, which you should be, and you should have done the Operators Pack. You should have gone out and subscribed right away. We're going to cover Gymshark. We're going to walk through the background of Gymshark, how they got to where they are today, where they're going, what's going on, and some of the movement kind of within the company. And then we're going to cover kind of strategic planning and making sure they're not wasting a bunch of time on stuff that doesn't matter. After that, we're going to quickly rip through some inventory stuff, is what I would call it, and ensuring you don't have a bunch of money sitting around.
Some inventory stuff. That sounds boring. Come on, give me like something to get pumped up about. What about your turnaround quote? Your turnaround quote was, I mean, I didn't really like it, but you liked it.
The inventory stuff will free up more cash for you, and you'll be a richer man by the end of the podcast.
That's what I'm talking about. All right, let's get into it.
And let's quickly say a thank you to our sponsors, Fondue, Numeral, Fulfill, and Iris. If you're listening to this, it's because of them. So go out, check them out, and let us know what you think.
All very high-end PV sponsors, so we'll get into that later.
Cool. All right, let's dive into Gymshark. What do you have for us, Drew? You've been following Gymshark since what, 2021, 2022?
Probably 22. They've been reporting their financials since 2020, and maybe just a little bit of context. In the UK, they mandate you, I think if you're over like 10 million of revenue, to actually report all of your financials publicly. So Gymshark is well over that. And so I've been watching this story for 4 or 5 years now, and people get pretty riled up about it. It's obviously a huge brand in the UK and growing in the US. So
they're really like one of the few successful D2C heavy stories, right? Like there's not many, and they're one of the few.
Yeah, I mean, we can talk a little bit about how they're performing now and where they might be going. But yeah, I mean, generally speaking, they're like the athletic greens sort of like apparel, where it's like they stayed D2C only forever, and they reached this like really critical scale. They might have even raised it the same valuation. I think athletic greens is maybe 1.2 and Gymshark was maybe 1.4 billion. But yeah, it's a really, really classic example of like the D2C model and how,
right,
it can scale, but they've had some challenges recently, so we can kind of dive in. What's your level of
the history? You want to start with the history of the brand? Like I'm kind of familiar with it. I've actually mostly just familiar with it because of the stuff that you've published. I'm not kidding. I'm just like, that's basically all I've read, and a handful of other things here and there. But I think it'd be great if you could kind of walk us through the history of the brand, how they got to where they are today, and then just like quickly summarize the last few years of performance.
Yeah, so basically, Gymshark's whole thing is that it's this company that was started, I think, in like 2012, and they started by this guy named Ben Francis, who's become pretty famous, and he has a co-founder named Lewis Morgan. Lewis Morgan is interesting, also the co-founder of another fashion brand called Maniri Devoir, which I've written extensively about as well. So that guy's kind of had a couple hits in the space. But essentially, like, they started out drop shipping like supplements, essentially off of their website. And then they really grew and kind of pioneered like the influencer model, right? So this is like the early 2010s and 2014, maybe mid 2010s, where they were kind of, I don't know if they invented it, but one of the first brands to really leverage Instagram and social media marketing.
They were getting really aggressive at the same time as Fashion Nova.
Yeah, exactly. So like they just, I mean, they did it perfectly. And so, by the time they started publishing their financial statements in 2020, they are, creeping up on $300 million of sales. And then in 2021, yeah, they raised from General Atlantic. So tell us who General Atlantic is and the significance of that.
Very, very chunky venture capital firm. They do a lot of late stage growth equity.
Yeah, they're like flagship consumer. Yeah, they're awesome. So they, they raised from.
Do they do a lot of consumer?
Oh yeah. Yeah.
I didn't realize, huh? Okay.
Yeah. Yeah. So they raised, what is it, like 80 million or something in 2021 and a $1.4 billion valuation when they had, 400 million in sales or so, growing 50% year over year. And everything looks to be going right. They had, EBITDA margins in the double digits or close to the double digits. And, this was supposed to be the next, I don't know, maybe not Lululemon, but the next, there's IPO talk. And over the last couple of years, they're still growing their top line. I mean, much slower. So like for context, 50% growth in 21, 20% growth in 22, 15 in 23, and then sub 10 in 2024. This most recent report was sub 10% growth. So that's fine. These are really big numbers. You're not going to grow 50% forever. But I think what kind of is grabbing the headline around this Gymshark report is the surprise and kind of the profitability line. So like their net income margin was 1.2%. And so when you're seeing growth start to really slow like that, ideally the earnings are coming,
Right.
or have already sort of came. And so they,
It's funny. I've noticed even with smaller brands, the trade-off isn't really linear. Like I think the highest quality brands that we've looked at, they're always growing really well and they're disgustingly profitable. And I'm talking like 15 to 20% net, not EBITDA. And
Mhm.
then they're doubling like year over year, which is crazy. Obviously, these are much smaller than Gymshark, but I just thought it was really interesting. Even brands doing like, let's say, going from like 50 million to 100 million, and they're still spitting off an insane amount of profitability. It's really interesting. I don't actually feel like I feel that there's this narrative where you're trading growth for profitability in consumer, but it's rarely the case. I just don't think it's actually a linear trade-off. And you'll see it a lot, right? Like this is a good example.
Yeah. Yeah, I agree. I think I was saying it a little bit more from like an investor perspective of like, if you're going to stop growing, then
Oh,
you're at least going
totally,
to
totally.
start giving me
Yeah,
money, giving me money.
yeah. You're
But as you
supposed to.
just
Like
said,
that's the common. Yeah,
yeah,
that's like the common in thing you'll hear from investors, or really even people running a brand where they don't have a lot of context, so they haven't seen a lot of brands. They'll think that, oh, because we're doubling this year, we can't be profitable, and it's harder, right? But it's I don't know, for some reason, whatever it is, if a brand's really really good, it will be profitable as well.
yeah, and I think maybe that's a good thing just to kind of quickly touch on before we get into the weeds here is like there's two ways of making money in investing, right? The first way is capital appreciation, and the second way is income. So if you buy an asset, the price of that asset either needs to go up or that asset needs to produce income for you. And those are the two ways of making money. And so that's how you can kind of think of like private equity investors is like, okay, like I'm gonna buy this brand and it's either going to continue to grow or it's gonna start paying me pretty quickly. And so I think Gymshark is falling into this territory where it's not really clear which one of those it's going to become, right? They're not really growing. They're not really making money. And with a $1.4 billion valuation, um, there's reason to be concerned here. Now, I think it's a very iconic brand and they could climb out of it. But you are kind of getting into that like no man's land of like, what's your like value here? I mean,
Right.
um, so anyways, we'll talk about maybe what could happen here in a second, but I'll kind of give you the highlights, the backdrop over the last couple of years from like a revenue and a growth perspective, and I want you to just theorize about what you think's going on here. So I gave you the growth numbers already. Gross margin, and this is like out of the report, so this is like their product gross margin. In 2020, it was 70%. And then by 2024, it was 63%, which is up from 2023, 60%. So a bit of like a down and then back up on the gross margin side. On the MER side, we've gone from marketing was 15% of revenue to 22% of revenue. So that's not crazy. That's typical. And then EBITDA margin, basically in half from 2020. So you've got a little bit of gross margin volatility. You've got, increasing CAC basically. Um, all the while, their channel mix hasn't really improved. So they grew their wholesale revenue like 600%, or sorry, their wholesale revenue like 500%. in 2023, and everybody thought that was going to carry them for a little
Right.
bit, right? I thought it, well, maybe not everybody, I did. I thought it was going to go from 10 million to 50 million. Instead, it went from, 8 million to 3 million. So it looks like they abandoned it.
Weird.
Yeah. So like,
I wonder
based
why.
on
I
what you
actually have a
know,
friend. I have a friend with a similar brand. I would call it like the
oh,
Americanized version of Gymshark. And I
hmm,
think they're doing like 70 or 100 million now at like between 18 to 25% net. And I know
wow.
wholesale is crushing for them too. But it's interesting they abandoned it. They do a lot of wholesale with more niche kind of outdoor retailers. I was surprised. But anyways, yeah.
Oh, cool. Um, yeah. So based off of like all of that, like what's your, based off of what you know about maybe apparel and just D2C in general, like, do you think they're running into a weird wall here? Do you think there's just like headwinds from like the category perspective, or like, I mean, it's a hard business. So,
Yeah.
this is not a dunk on Gymshark by any stretch. I kind of want to get a little bit smarter about, what's going on here. Is this a difficulty, or is this success, or, what's your take?
Yeah. Maybe it just has to do with like macro headwinds in the space, right? I think anything fitness related was really, really hot 2020, 2021. And then we've looked at a few brands where the LTV started to wear off closer to 2023, if that makes sense.
Oh, interesting. And you think that's a
And they,
macro thing?
I think it could be, especially at that scale, like macro really hurts you. And it's hard to outgrow macro. It's easier to outgrow macro
Hmm.
shifts when you're smaller, say sub 50 million. But
Yeah.
you really, really feel it when you're larger and you're kind of butting up against. I wouldn't say like there's not like they're butting up against TAM too big away, but it's still a real concern, right?
Yeah.
So yeah, I think I would assume it's mostly that. And then obviously the main channels they're using just become saturated and harder to play in, right? CPMs in the fitness space are bananas. They're totally bonkers. I don't know if you've ever tried to pay an influencer in the space, but they are very expensive relative to other categories.
Like, how expensive?
Like anywhere from 1.5 to 2.2, 2.5 times the price of what you'd
Really?
normally be paying.
So do you think that they're in like, given the MER trend, to me, like I look at the MER trend and I'm like, this is just a growing business, or like a business that is like very large. I mean, they did 600 million. Um,
Yeah.
so maybe there was like something going on, like the influencer side, and they just like haven't been getting the same leverage out of it. I mean, influencer in general is definitely. I mean, we used to deploy a lot of influencer dollars, and some of these people, I would just be like, I am not paying you $12,000 for an
It's just
Instagram
hard to make
post.
the math work, right? And the problem is there's always some moron with a bigger budget than you that will go out and pay that, especially if they've raised venture or something where they'll just like burn the money without really looking at the CPM.
So yeah, so like back on the Gymshark thing, like they're probably facing like some macro. I mean, maybe it's just like a hurdle. Maybe like this is just like, the sort of 20 million. I call it like the 20 or $30 million like cyber wall in D2C, where it's like it's really hard to break through that. But once you do, you're kind of on your way, I think, to 100 or at least 70. And so maybe, they just got to get through this like 600 million, $700 million, sort of hump, and then they'll be riding off into the sunset. But until they do, earnings are muted, from an accrual perspective. But what's interesting here, and this is why everybody likes to talk about Gymshark, and we've talked about sort of negative cash conversion cycle, on one of the last episodes, and I'm not a
Hmm.
fan of it. I'm not like dogmatic about it. I think for 90% of businesses, it's probably a really bad idea. But these guys have actually kind of pulled it off again. So Gymshark's cash conversion cycle, when they were famous, was negative 100 days. That was
Wow.
2020. And so this is kind of comes back to the forecasting
That's really
problem with
good. But
them.
it's actually kind of bad. Stepping on Lego. Have you ever stepped on Lego? Has that ever happened to you?
Not in a long time. I have at some point, I'm sure.
Painful, infuriating, totally avoidable. The good news, Numeral are your tax-proof slippers. They're a holistic solution for sales tax compliance, and they have an awesome guarantee where they'll cover the cost of any mistake they make. I have a ton of friends using them. The guys at Emmy use them. And a ton of other really large, chunky brands use them. I can't think of anyone better and easier to use than Numeral on the sales tax side. They really do make it easy. So just head over there, let them know we sent you, and try them out. Again, like very simple to use. My favorite part about them is that their pricing is a lot more transparent. They won't slap you with any surprise price increases or anything like that. So give them a shot.
Yeah, I think I said this maybe in the last episode, but it's something like Numeral is I didn't used to appreciate the power of of Numeral, but once I saw one of our customers and like the mistakes they were making with regards to sales tax, it's extremely expensive. Like you don't even like know what you don't know there. So I am a huge advocate of those guys. I think it's just like one of those like mission critical sort of, you know.
And they even have they have free monitoring. I didn't know that. I'm just on the website, just messing around with it. They have free monitoring. Mike's Hot Honey uses them. So now you have no excuse. All you lovers of Mike's Hot Honey, you need to get on there, sign up, let them know we sent you. It's numeralhq.com.
Cool. So the cash conversion thing, 2020, negative 100 days. 2021, 39 days. 2022, 68 days. Okay. So it always says the same thing to me. I thought I was going to grow more than I actually did. And so you saw negative 100 cash conversion cycle go to 68. And then that's actually, so in between that is when they took the equity from General Atlantic, right? Okay. So they saw their negative cash conversion cycle kind of flit. I don't know if they got nervous or if they thought it was good timing with the market. It was great timing with the market. But they were basically able to show the balance sheet. Can we actually
talk about the growth equity round from General Atlantic? How much was it again?
80 million, I think.
80 million. And then do you know what percentage went to secondary?
It's actually a good question. So if I pull up, they had a line. Oh, I don't know if I'm gonna. Oh, here. Okay. So I don't know how to read this exactly, but in their statement of cash flows. So obviously investing cash flow section of the cash flow statement, they have an equity issuance line in 2021 that says 80 million. And then the line below that says payments to former shareholder, 100 million. So to me, that reads like there was 100 million of secondary.
I think so too. Yeah, that would make sense.
So yeah, so cash conversion flips positive meaningfully. Cash, the net operating cash flow for 2022 was negative 33 million, largely driven by inventory. So they used $50 million of inventory in 2022. And then that was their only negative sort of operating cash flow year though, because then they got back. So in 2023, that cash conversion cycle, I don't know how they do this. I don't know how they sustain this, like, let alone I've never seen somebody go from negative to positive back to negative. Usually it's like you go from negative to positive to dead. So they went from negative 100 to 39 to 68 to negative 3 to negative 29 in the most recent report. So these guys have seemed to really sustain this idea of a negative cash conversion cycle. And they must just have a really good deal with their supplier or something.
I think so. That would make sense. I've seen a few totally crazy deals. Like, who was it? Someone just texted me the other day and they said a lot of their inventory was on consignment effectively, so they can scale really, really fast. It's a friend of mine with a jewelry brand, actually, now I remember. And I think they'll go from he thinks they'll get to 100 million in EBITDA relatively soon in the next few years.
Jesus.
But he told me their free cash flow along the way is really, the actual cash they can pull out that's distributable is very, very good because all their inventory is on consignment, more or less.
That's awesome. Does he pay a premium for that? How are his margins?
I have no idea. I think his margins are pretty good. But he's literally probably the best or one of the best operators I know. Very tight. Scaled multiple brands to very chunky numbers. So
100 million EBITDA. I'd have to agree.
Well, they're not there yet. They'll be there. I actually honestly think he'll be there pretty soon. I'd be shocked if he didn't. And then let's talk about discount codes. They're kind of like mullets. Popular in theory, terrible in practice. Fondue swaps discounts for cash back. They're one of our sponsors. They keep your margins up front and healthy and the customer party in the back. Kind of like a mullet. Cashback is an easy promotion to work into your testing cycle and could yield huge results. Memorial Day is coming up, so is Labor Day. Leverage Fondue for one of these holidays and see if it's something you want to really leverage during PFCM. So I'd use one of those 2 holidays to test, see how the promotion goes for your brand. Again, it's really cheap. Fondue's not expensive or hard to implement. Go grab it. give it a test, see how it does, see if your net margin ends up being higher than your normal, just straight up vanilla discount. And if that works out, you should implement it during a heavy sale period like BFCM, and you'll end up harvesting a lot more margin for the year. So now is really the time to be testing stuff like promotions and promotion strategies to see if you can find something that kind of wins and carry that into BFCM where it's a heavy period. Um, Again, really easy to implement. No reason not to do it. Only a tiny fraction of your customers will claim the cash back. So it's totally worth a shot. Head over there, let them know that we sent you.
2 days ago, I woke up at 3 a.m. because I wanted to be the first one to break the Gymshark news. And
Are you
I was on
serious?
yeah, it was stupid.
Oh my God. Okay.
It took me 6 hours starting at 3 a.m. to do all this. And
Wow.
so I was in hour like 4 on my 6th cup of coffee studying the levers of Gymshark's gross margin. And I didn't know how or why they were able to get their gross margin up from 60 to 63% this year. And it dawned on me that fondue is the only answer. They must have implemented fondue to drive that much margin expansion with inventory bloat and macro headwinds and tariffs and everything else. So
Perfect. Totally
if
makes sense.
Gymshark's using it, I don't actually know if they're using it.
Okay. Cool. Is there anything else you wanted to cover on the Gymshark side? Like, what
I
do you
think
think
it's
happens now?
yeah, so that's kind of the last thing I want to sort of touch on. So basically you have this really high growth, high profile, obviously trendy brand, and you've seen it time and time and time again in apparel. It is so hard to keep up with consumer trends. It's so hard to keep going. They're doing it. They're still growing. They're not Allbirds by any stretch here. But the future is becoming unclear to me. You have
Right.
deteriorating, accrual profits. You have slowing growth. At the same time, you have a very nicely managed balance sheet with that cash conversion cycle coming back negative. So they're still really well positioned from a liquidity standpoint, from an operating standpoint. You need to get this gross margin back to 70%. You have to. And if you don't, I don't know where you go from here. You have to downsize revenue, right? Because you got to get more leverage out of your marketing line. So my biggest concern is just the valuation that was paid in 2021. Oh, and actually, here's an interesting tidbit that I should have brought up earlier. In the corporate governance section on like page like 63 of their filing,
Oh, good. You
they
really did read it. Holy shit. Okay.
no, I did. And so these companies' house PDFs used to not be readable by ChatGPT, but now they are, which is huge. So essentially, basically, what they did is they created a new class of shares called G shares. I don't know if Gymshark
Mhm.
stands for or G
Right.
stands for Gymshark or if it's like a series of G. I don't know. But
I get it. I get it. Yeah.
the only person that received these shares was Ben Francis. So he left or like he like stepped down or left or got fired or whatever as CEO, and then he came back. Remember, and they topped him up with equity. So I'm not going to speculate on why or what that means or what the goal is, but I did think it was an interesting tidbit from sort of like a overall valuation perspective, because basically the way that the options are structured is like it's only liquidity events that are those are going to pay out. Like there's no
Mhm.
other really way for him to monetize those.
Makes
There's
sense.
no voting rights on them. There's very little like governance rights.
Right.
Uh,
Right.
so stay tuned. I will be covering it same time next year. I'm hopeful. I think they can pull it off. I think it's a really iconic brand. I would love to see them, continue to march toward that IPO. But this print, I don't know. I have more questions than I did a year ago, I guess.
Yeah. I mean, we'll see. It's a difficult period for a lot of brands right now. I think a lot of brands are kind of, I wouldn't say meandering, but like relatively flat, which is kind of a win right now, depending on your category. If you're in beauty or something and you're flat, you're actually doing better than most people. If you're in apparel, a lot of apparel brands running into difficulty, especially athleisure, et cetera. They're kind of cooling off from where they were. So yeah, we'll see what happens next. I'm very curious, especially given what's going on with the macro economy now. You want to jump into the strategic management thing?
Yeah, let's do it. Give me the rundown, the brief.
Okay,
I'll give me the
cool.
overview first.
So I was doing a lot of, I probably the thing that sucks out most of my time is doing a lot of strategic planning with our portfolio brands. I will typically join them end of quarter for on-sites. Um, and
What
I
does that
think the
look like?
biggest, what does that look like? It looks like me flying out and working with them in person for 3 to 4 days.
What are the
Um,
I'm actually curious of this because like where I'm at in my business right now is extremely not strategic. So I'm curious, like, what are like the core deliverables that you're imagining when you say that you're going to do strategic work? Because a lot of times when I hear that somebody is like doing strategic work, I just think they're doing nothing.
Well, so we run most of our brands off of Traction slash EOS, if you're familiar with that. So it's basically setting quarterly priorities and make sure they line up with the annual priorities, and that all flows up to like the three-year goal, if that makes sense.
But so like how like long does that actually take?
That takes a while, usually. It depends on the
Okay.
brand and how good management is, but I would say it probably takes 1 to 2 years of running Traction before you're actually good at it and you're good at strategic planning. And when you read the book, have you read the book?
No.
I think you would love it. I would recommend reading it because I think you'll get a lot out of it. But it takes a little bit to really nail planning portion. And I think companies usually mess up the first few times when they set their rocks, which are basically OKRs. Are you familiar with OKRs?
Mhm.
Yeah. Yeah, they're pretty popular in tech, I think. But it takes them like a few quarters to really nail that. But I think helping them think through like what priorities should be and then actually running the math. And let's just get into this. So uh, it'll kind of become clear once I walk through this. So
Okay.
let's first think of like an impact effort matrix, right? So impact y axis, effort on the x axis. Easy wins are typically something that's like low effort and high impact, big bets, high effort, high impact, and then money pits, which everyone knows you should avoid. I don't think anyone's going to be surprised when I say it. They're they're high effort and they're low impact. So I mean, it's a pretty stupid place to spend time. And then there's the incremental bucket, and that's low effort, low impact things. And I actually think this is like one of the biggest death traps for a business. A lot of the time, when you look up an impact effort matrix, you'll hear people say something like, oh, handle the incremental quadrant when there's extra time available. But the reality is, if you're a startup, and yeah, honestly, even if you're below like 200 million in revenue, maybe even more, there's no real extra time available. Like there really shouldn't be any extra time available. And if you can't think of higher yield initiatives that are high impact, it's a bad sign for management, right? Like management's job is to ensure everyone's focused on projects that generate high returns on investment, and that's what gets you to exceptional growth, exceptional profitability. Um, you really want to load up with as many projects as possible, fall into easy wins and big bets, and sometimes it's hard, but I think that's why it's worth talking to other co-founders, joining communities, et cetera, to get more and more ideas flowing in. Um, yeah, I think the simple math here is, do you know Dave Rekuk? I actually don't pronounce his last name. Dave Rekuk? Dave
I
Rekuk?
think it's
Skincare guy?
I don't know. Yeah, I know Dave. I don't know how to say his name.
Yeah.
Rikic?
Yeah.
Rikik?
Rikuch? I don't know. It is.
Rikuk?
Bottom line, bottom left quadrant. I like what he said. He said like the bottom left quadrant's so bad, like the incremental initiative thing, because you end up spending way more time on it than you thought you would, and the impact's a lot less than you thought it would be. And I think like the best example of this is something like a split test, where it's horribly complicated to launch. You'll probably mess up launching it the first few times, even if you have an internal dev team. They'll mess something up. The test will be invalid. Then you have to rerun it. It just happens when you're doing a lot of split testing. And the yield on those split tests is rarely as good as you would think, especially if you're doing something stupid like testing button colors. Just don't do that. You should be testing things like pricing, free shipping cutoffs, or offers. Don't sit there testing button colors or too much UI/UX stuff. Just complete waste of time. Like another good example is like dashboards, right? You don't need a dashboard with a ton of crazy extensive automations that's custom and hand built for you. Just go and sign up for something else. Sign up, like use Iris, use anything you want. Just even if it's manual, just have a VA go in and pull it every day. It'll be cheaper and faster. Um, I remember a big takeaway I had when I actually met Sean in person from Ridge for the first time. His dashboards were super simple and in Excel. And I think they're doing like 100 or 120 million then, maybe they're smaller, like 80 million. I don't know. But it was a very chunky business, and he didn't like build out some crazy custom Tableau dashboard
Yeah.
that updates in real time or any of this stuff. It was just very straightforward, easy to edit, easy to pull the data you needed, et cetera. So don't waste time building cool stuff that doesn't really do much. Um, I think a really big antidote for this is making sure the team understands how to prioritize initiatives. setting relatively high return targets and expressing that in a quantitative way. So for example, your team should know what like MOIC is and IRR. Do you want to just walk people through what those are?
I was gonna I was gonna say, yeah, do you look at it like IRR or like NPV?
Yeah.
So basically it's just a return on investment.
Mhm.
So, like it's the same way that like when you spend $10 on a CAC, you think that you're going to get $50 in an AOV back. If I spend, $100 or let's just say like 100 grand on, this project, what's my expected return on investment? And then you can basically, this is the way that it's classic corporate finance. Like basically what you do, and I'll be curious if you corroborate this or not, but like you come up with a list of things that you could do, whether it's, implementing a new ERP like Fulfill, or testing Fondue,
Wow, those are
or
great initiatives.
or using numeral for
Wow.
your sales tax. So basically, like what you would do is you would basically model what you think your business looks like after doing each of those things, and then based on the
Wait, did
expected,
you say model?
yeah, you model
Wow.
them.
When you say the word financial model, do you think Picasso or Bob Ross?
Picasso.
Okay, see, I think a lot of financial models, they are like Picasso, right? They're very messy. Sometimes they can be pretty, but they're very, very messy. The reality is, if your financial model looks like a Picasso painting, Iris is your financial Bob Ross. Calmly painting clear, happy profits, no stress, and smooth operating. Sorry, I just had to say that. I thought it was funny. Okay.
Exactly. So what you'll do is you'll come to us, and we will help you decide between numeral, fulfill, and really it should be all of them. It's going to be all of them. It matters what order. So basically the order is just is by order of NPV or
Yep.
IRR, or I guess I haven't really heard MOIC used in a corporate finance setting, but that works too.
Yeah, I
Um,
like it because it's like fairly simple math, right?
yeah.
For us, it depends on the company and the size of the company, as well as what risks it removes from the business, right? Like you can't really put a price on that per se,
Mhm.
but you want to set a generally high target, like 5x within 12 months or something on your money that you're throwing out. The reason for this is that it gives you a buffer for failure or underperformance, which is going to happen. I mean, the reality is no initiative is going to work 100% of the way you thought it was going to work. And the goal should be to do as many of them as fast as possible and make sure they're very, very high leverage. Um, the other thing too, I would factor in is the resources that you're deploying into it. It's like when you're looking at the
Mhm.
investment required, like actually take the time to map it out. We call it cycle mapping. I don't know what the actual phrase is for it, but essentially we'll do something like, okay, our goal is to spend, I don't know, you want to increase spend by like, I don't know, 500K or $1 million a month on Meta. What do you need to get there? You need creative. What do you need for the creative? You need a creative team or you need agencies. So you have to map all that out. Like, I'm going to find the agencies by week 3 of the quarter. I'm going to have them hired by like week 4. They're going to be up and running and deliver their first creatives by week 8, stuff like that. And mapping all that out is really important so the team can see how everything cascades down. And that way there's not too much pressure on an individual week. You can move things around because you don't want your marketing guy getting requests from 6 different teams or something like that the same week and asking for help.
Yeah, and I think I like the way that you talk about it because you use words to talk about it, right? And you can also use numbers to talk about it. And I
Yeah.
think of like the financial model, for example, is just a quantitative representation of the words that you just said, right? So you plan it all out, you model it all out, and then you just pick the best ones, and then that's your quarterly goal. And we
Yeah, and
actually
again,
do this with
you don't need to be super precise, right? Like you can be I actually think if you have to be super precise, it's a bad thing because it means it's not as obvious as a win as it should be, if that makes sense.
right.
Um, so for example, something like launching new product, it's pretty clear what the outlay is going to be, if that makes sense. Or you'll roughly know, like, okay, maybe you're an apparel brand, you've never launched hats before. It's your first time launching hats. You don't have a super clear idea what COGS will be. You can probably get a rough estimate of what they are very quickly with a few Google
Mhm.
searches. Even if you just went and like searched on AliExpress or Alibaba, your pricing is going to be better than that. So um, just stuff like that, and then quickly mapping out like, oh, this is the minimum buy that we need to make. This is how much we need to put into testing behind it, and quickly map it out to see like, okay, what's the potential win? What's the risk we're putting up? I have a really good friend who owns a fairly large brand doing 9 figures, and he left the company I think he sold his equity. I can't remember, but he was just talking about how the team launched a bunch of products that made no sense. Like there was no clear IRR for the products. They way over
Yeah.
invested in them and it made no sense. Like no one took the time to sit there, map it out and be like, okay, what channels can we sell this across? Can this even sell in retail? And the answer was no. So like no one had thought through, we're launching a bunch of products that we can only sell on our D2C channel. And honestly, the math doesn't even really work for them because like the AOV dynamics don't make sense. So think all of that through really carefully and map out the potential MOIC.
And that's so we built benchmarks into our platform.
Oh, cool.
Which are not like the typical I'm sorry, I don't care about CPM benchmarks. And I think that kind of comes back to like the low impact, high effort thing where people are like sort of like constantly trying to over optimize for like the most like minute, click through ad, whatever.
And I think marketing Twitter is really bad at that, by the way, where they'll start talking about
bad.
running paid channels or something like that. And the reality is whatever you do on paid channels ultimately does not matter nearly as much as something like product, right?
And that's what I'm saying. Like I started doing content creation because I was on Twitter running Mad Rabbit. I was trying to figure out what to do. And I was like, all these people are just yapping about nothing that actually matters. It's insane to me. Like I don't care about any of that stuff. You care about running a business that works. And if you are, look, there's exceptions, of course, but like if you're gonna like bang your head against the wall trying to like optimize your CTR, like one of your, ads for 6 weeks, like you're just gonna die there. So what I was gonna say though is we have benchmarks as part of Iris, and so like basically the way that we help, I think this actually fits nicely with what you're saying is like it's one thing to like build a model and like have a plan and like do this strategic planning. A lot of these operators don't have any idea like what they should be searching towards, right? So like it's really like we have this one I guess they're like a supplements brand. And like they came to us and they were like, we want, to overhaul our model. And they had like a gross margin, sub 50, let's say. And I was
For
like,
supplements,
this
sub
is
50?
Exactly. Yeah.
That's rough.
And I was like, it was the first thing. And so that immediately is the highest NPV initiative, right? Like by a mile. It's a layup. Like I look awesome to them now. And I said, okay, but it's one thing to just be like, let's grow our gross margin, expand our gross margin.
Do you want to explain NPV?
It's the same thing. Same thing as IRR. Honestly, IRR just sort of adjusts for like time.
Oh, we should explain that too.
So basically, like you have an outflow, right? So like it's IRR is most commonly used in investment settings where like basically you have an outflow that yields an expected inflow at some point in the future, and whatever that you use. I don't know the exact formula for it. Do you know the exact formula?
I can't remember. It's basically just measuring your return, accounting for time. That's all.
Yeah, but it's not in Excel. You just type equals IRR.
Yeah, I do. Yeah.
Yeah. So yeah, it's like a time adjusted return. But so in the case of the supplements company, that was a layup, and so we like built out their model. Like not just saying like let's get gross margin up, like it was like let's first get gross margin to sort of like the middle of the benchmark, and then ultimately we have to figure out
the reason the benchmark matters there, especially, is because you're not going to be able to compete in the auctions if you're selling via digital channels, and you're certainly not going to be able to make retail work, right? I mean, retail expects certain pricing, and you're not going to be able to hit it if your margins are way below industry average. The only way that works where you have below industry average on the margin end is if it's actually producing more volume and you're tapping into TAM that's not there otherwise. But for something like supplements, that's not the case.
Right.
It's just like how that's rarely the case for beauty, by the way. It's just a structurally high margin category. And there's no such thing as launching a beauty brand with low margins that offers more bang for buck and value. No one cares. No one wants that. Despite what they say. They'll say they want that, but they don't actually want that.
Yeah, fair enough. So anyways, I derailed you a little bit, but my point was just prioritizing those initiatives and then also having the context to understand like what's realistic.
Mm-hmm.
But continue on, please.
Yes, I mean, like really the TLDR of it is don't waste a bunch of time doing small incremental initiatives. Don't put them on your quarterly goals, even if with your company, like let's say you're doing a quarterly offsite, you're planning out the quarter, what you guys are going to spend time on. Don't add a bunch of stuff in there just because it's easy and fast to do, because it always ends up taking longer than you thought to nail, and the impact ends up being less than you thought. What you want are a bunch of really big bets, and that way, even if some of them fail, you only need one to work and pretty materially change your company, right? Um, we've definitely had that before with a few brands where one or two things worked out, everything else kind of failed, but it didn't matter because the company still was able to like bolt on another 30 to 50%. In either bottom line or top line or something like that. So just think that through properly when you're doing your strategic planning, because it will bite you. And I know it sounds dumb if you're a smaller brand, but really do plan everything out, map everything out, and make sure that the timelines actually align and they make sense. Because we just see this. I mean, I think the dumbest thing you see often is someone will be raising money. They'll come to you and they'll say, yeah, we're going to do $30 million this year. And you say, oh, well, are the orders placed to be able to sell $30 billion of merchandise? And they'll say, no. Like, oh, okay. Well, I mean, I don't think you can actually hit that revenue target then. So I'm not saying anyone would do that listening to this, but it's a classic example of something like that, right?
Yeah. Yeah. I mean, it's putting the cart before the horse a little bit for sure.
Yeah, exactly. Let's talk about the impact of a bad inventory decision, a bad inventory buy, and then de-risking it. I'm sure you see this a lot. Like, what have you seen as far as bad inventory purchases? I can walk through a few really good examples too, but if I figure you might have some.
I think about it a little bit more, maybe like holistically. I think it's pretty binary. You either have like a good or a bad sort of like quarter of buying. And I think people that they sometimes they don't understand like what their slow movers are that well, and they don't realize that they should be like tapering off the sort of volume for that. And basically like identify like, so, you know, what I always say is like the way that you should be sort of forecasting your sales has a bottoms up SKU build with it, right? Which is also kind of the demand plan. So like if I'm going to do $1 million in sales next month, like how many SKUs is that? Or how many of each SKU is that? And so I think people, when they don't do that, they kind of lose visibility around what they should be buying. And then they end up the way that you like accumulate slow movers is not like you buy one big inventory batch and then, you know, it doesn't sell. It's much more slowly than that. So I think just like keeping an eye on like hero SKUs and SKUs that you know are going to move, and like doubling down. And again, back to that like low impact, high effort would be like buying basically your worst SKUs. Like a lot of these brands should cut their SKU count literally in half, and then they would be way
It
better off.
simplifies the operations. I don't think people realize how valuable simplicity is, right? Like it's much easier to run a business with just less SKUs floating around. And often
it's the same
it doesn't
thing as
hurt
retail.
conversions much. We actually ran a test where we sent customers I've run this test multiple times across multiple categories, where we sent customers from search, it's like AdWords, specifically to collections with less products on them, and they did better. Like, it's very consistent. And if you guys want to see something really quickly without having to test, just open up Google Analytics and go to see how many of your users actually go to page 2. So if you're selling a lot of SKUs, what percentage of people actually click through to page 2? And I think you'll be a little concerned. You'll be like, wow, almost no one clicks there. Why do I have all these products there? And I would say the same thing. Yeah, why do you have all those products there? So you'll feel really stupid after you go do that. Because I know I did. When my co-founder was like, go see how many people go to page 2. And I'm like, oh my God. So anyway, sorry. Keep going.
No, that's I want to hear what your examples are.
Yeah, so we have quite a bit of we've done a lot of really high SKU categories. So obviously we have like a floral brand, artificial floral. It's like a lot of crafting, just end up a lot of SKUs. Same with a lot of apparel that we've done. Naturally tends to be a higher SKU count category. I think the really big thing is over time, I've personally leaned more into it's better to sell out of something than it is to accidentally overbuy. Sitting on too much inventory is really, really toxic and really hurts you. It just locks up so much cash. And like you said, typically people don't see it. like when I say you're sitting on too much inventory, people think like, oh, I bought too many of this one product and now I'm sitting on this one product. That rarely happens. In apparel, you'll see something like it'll just start to accumulate into this mass and there's no liquidity mechanism for that. And then you'll go out of seasonality and now you're really screwed, right? Like you're sitting on all this winter product. Suddenly it's March and you're like, okay, what do I do with all these winter coats and all these like winter boots and stuff like that? So you don't want that to
And real
happen.
quick, just to
Yeah.
interject, if you have like a revolve, like an asset backed lender, they'll have a definition for slow moving inventory.
Yeah,
And
typically
they
you want
won't
to do like an ABC analysis, but just all you're doing is you're just bucketing your inventory more or less. But I think the really important thing is to make sure there's good liquidity mechanisms for slow moving inventory. If you are running a larger catalog, the reality is you're testing way more than someone with 3 hero SKUs. And because you're testing way more, you're going to have more failures too, just naturally, right?
What are some
with that-
liquidity mechanisms for getting inventory?
I think
out?
free gift is a classic one. It's just mystery gifts, mystery product. It can totally rip. You can run like a mystery promotion, et cetera. The other one's just having some sort of discounting mechanism, right? If you're worried about brand or something like that, you can mostly filter that through the back end. So just start by offering those deep discounts to just using it as like reactivation bait, if that makes sense.
There was one time, I don't know if we ever actually ended up doing this, but we did a packaging refresh. I think it was to go into a retailer, and we had to like basically do a new packaging, and so we had all this obsolete packaging. And I don't think we did this, but we were going just to like fill it and send it to like TJ Maxx for like 50 cents on the dollar or something and just liquidate it.
Yeah, TJ is really great. They're actually a very, very good partner to work with. If you're running that sort of issue, they will just straight up buy your inventory.
Isn't their stock
free.
like ripping too?
I wouldn't be surprised. They've done a really good job. And I've heard, I actually don't know anyone who's had a bad experience with TJ, by the way. Like they do exactly what they say they'll do.
Dude, their stock is up 165% in the last 5 years. It's up 36% in the last. Yeah, they're shredding. Oh my God, what? 28,000% all time. This is like, what is Amazon up all time?
Drew's getting excited.
Well, that's great. Why can't I do this? Okay. Oh wow. Okay. Amazon's up 189,000% all time. That's pretty good though.
So, yeah, I mean, just like retail partners are obviously an option. Discounting is an option, and things like mystery gifts can be great, like free gift with purchase, and you just throw it in there. This also kind of goes back to testing different promotions. So using something like Fondue, offering more aggressive cash back, and then maybe you sort your collections in a certain way so that those are up top. And when you send people to a promotion, send them there, and hopefully you sell more of those products. So again, I think just being really conscious of the drag on your balance sheet, especially, right? Like you're tying up all this cash, nothing productive is going on with it. Don't be one of those people that's like, oh, I don't want to lose 30% on that buy. Because you're going to lose a lot more than that. Like you're sitting there with unproductive assets.
You said something earlier that I didn't know a lot about. ABC analysis.
Yeah.
Does that make me a rookie?
It's just basically, you just divide out. Like A will be like your highest value, C is the lowest value. It's basically like an 80-20 rule. And you can... It's just categorization. That's all it is. It doesn't mean anything. It's just buckets.
Yeah. Okay. I've done that before. I didn't know it had a name though.
Yeah. And you'll see something like, maybe a good example would be like 20% of the items account for 70% of revenue or something. Then your B items will be like 30% or 25%.
Every single brand on Iris, I don't know how many there are, but they all have a hero SKU every single time. There's always a hero SKU.
So if someone's not doing that, you can run that math. And again, ABC is just a fancy word for just bucketing stuff. There's lots of good examples floating around online. Just run the analysis really quick, see what's actually meaningful for your business and what's not meaningful. And if you can, cut SKUs, right? We had a brand that for a long time, it looked like best case scenario could only net 8 to 12%. And after doing a lot of work on the inventory side, on the product side, it's netting close to 20% now, which is cool. So that's much healthier.
We've got a SKU analysis section in Iris.
Oh, cool.
And so the ABC has 3 categories. I used to just do it in two
Mhm.
because we didn't have that many SKUs. And so I would call it fast movers and slow movers. But I like this idea of ABC, and I just slacked it to my team, and we're
Well,
going to build it in
let's
here.
build it. You should call it the Mehtab analysis.
I'll have them put like a photo of like your face in the UI.
And it should say a little comic thing coming out saying work harder, sweat more.
Yeah.
Okay, cool. So there's all this. As far as other liquidity mechanisms, you can do things like back end upsells. I think that's great, right? Like, oh, get a pair of these winter. It's really hard. Like clothing, apparel specifically is really tough. You're not going to sell winter clothing in the summer. Sorry.
What do you think of those like fake "we're going out of business" sales?
Probably a bad idea. I
I
wouldn't do
agree.
that. It's aggressive. But again, the real thing is getting ahead here and making sure you don't need liquidity on that inventory at like a really bad time, and you don't need to force too much of it out at a bad time. Like it can really just bite you in the ass when it happens. Um, and it becomes bad hygiene, right? Like your product or merchandising team at an apparel brand might just be buying too much and taking too many tests in dumb ways. And you need to think of how do I minimize the cost of each test then, right?
Mm-hmm.
Because it's a big part of apparel is like making sure when you test new SKUs, because you're going to find heroes, you're going to find winners. You need your ability to double down on them is really important quickly and get more inventory. But then vice versa, you want to make sure each test doesn't cost you too much. You're not accumulating too much bad inventory per test. So cool.